All right. Apologies for the little delay there. We'll go ahead and get started. Oh, actually, sure. Yep, I'm screen sharing. That's good. And okay, fix the background. All right, we're good. So, welcome to everyone to Trading Coach's Playbook. This is Brandon Wendell with you for what is it? Friday, Friday afternoon now. And welcome, Brenda. Welcome, everyone. Before we get kicking this off, I just need to remind everybody that we are not broker-dealers or investment advisors. I am sitting here for educational purposes only in my cabin in the woods. As you can see behind me, everybody always thinks it's a fake background, but no, this is real. Um, anyway, where are we here? Yeah, so we're doing this for educational purposes. It's always risk in the markets. We're not giving any personalized recommendations to buy, sell, or hold anything. Or give any, there's always risk in the markets. We can never eliminate the risk. We just try to minimize and manage it, and we are not subject to trading restrictions. We got positions in security or initiate one at any time. And we are pretty busy here. As you can see, there's quite a few free online workshops. Every Monday, you can join Rob in Power Hour. We do the Trading Coaches Playbook, of course, every Friday. Rob's doing, if you like it, put a fib on it. That's cute. I like that. I'm busy with a bunch of programs. I do E-mini Think Tank, as you can see by my shirt, and also in the, the screen there, you can see that Monday, Wednesday, Thursday, we do live analysis of the futures markets. And I'm actually going to be talking about another program that I'm in charge of that I'm very active in, and that is called Wealth with Spreads. Excuse me. Basically, today we're going to talk a little bit about how we can reduce some of the risk when it comes to trading in our retirement accounts or in general when it comes to futures trading. Because obviously, when you do futures trading, most of us do what's called directional trading. And the directional trading, you see, where am I going here? There it is. If we just go out and think that the market's going to go up or down, we can go ahead and buy or sell that particular security. So for instance, if I go to NQZ 2024, the current futures contract, we could do our analysis here and identify, okay, well, come on, Alt R, what did I do here? Too many tools on there. Let me clean this up. And wait a minute. Is this locked? Scales. Nope, it's not. So why is it not redoing the scale? That's weird. You go to daily. See, that fixes it. There we go. Maybe. Nope. Back on the 60s, still acting weird. There we go. That's what I wanted. So anyway, we would do our analysis. And for instance, if we saw that earlier, this is on the 17th, yesterday, that prices were coming up to a 60-minute area of supply. Now, it just missed the area, but if it had hit it, we could have put on a short position, expecting the markets to drop and potentially profit from that. Or vice versa, if we saw that the markets were coming down to an area of demand and we were expecting it to bounce, well, we could potentially buy there. Let me just do something else. I'm going to go ahead and log in to Wealth Builders HQ website real quick. But basically, yeah, all those links are for my different programs that I have. You kind of have your choice of what do you want to do. But anyway, I'm going to focus a little bit, like I said, on those not necessarily the safest, but safer, if you will, because the type of risks that we take in the markets, we need to identify that before we get into a market. For instance, if you were to buy at this buying area right here, even if I narrow it the way it is, you still have about 30 points, a little under that, actually 25 points of risk. And 25, that's per contract. Now, obviously, we can do some things to reduce our risk. So for instance, was it 25 points, $20 a point? We're looking at $500 worth of risk, just the size of the zone. We'd probably have to take on a little more risk by putting our stop beyond that zone, obviously. So if you're not willing to take on that $500 of risk, what do you do? Well, fortunately, now we have MNQ, the micros that are available, same chart for the most part. It might be a couple ticks different, but not really too bad. And you can see again, yeah, it was slightly different. It says 79 to 304. It went to 305. But the risk is much, much lower because of the value, the point value and the tick values. Here, we're only looking at $2 versus the full-size NASDAQ contract. We're looking at $20 per point. So we can adjust our risk in the what we trade. When it comes to risk management, I've said this many, many times before, there are really only three things that we can do to manage risk. And that's the only thing within our control in the markets is how much we're going to lose if we're wrong or risk management. I mean, that's really the only thing you control. If you can control if the markets are going to go up or down, please let me know. We'll make lots of money. But as I can tell, nobody can do that as of right now. Even with the space lasers, you cannot control whether the market will go up and down. So only hurricanes. Anyway, I'm not going to get political. But when it comes to risk management, one is size. Okay. And that refers to the number of contracts and the type, right? So, and this goes for shares as well as futures contracts or even lots when you're dealing with Forex, because you have standard lots, mini lots, micro lots. Well, here you can do minis or micros. Now, they're not available in every security, but that's one thing that we could do is the number and type of trading, or sorry, securities that we do. Another thing that we can do is change the duration, and that is the time frame of the chart and holding period. Those are actually related. If I'm looking at a 1 hour chart, most likely the trades that I'm getting into are only going to last for a few hours to maybe a day or two. They're not going to last much longer than that. However, if I get into a daily chart, I might be looking at holding multiple weeks. If I do weekly or monthly, it could be even longer. If I go down to a tick chart or a share bar chart where I'm only looking at just intraday moves, then my duration is very, very small. Well, the larger duration you go, the more risk you have. The more time that you are exposed to the markets, the more chances there are for the markets to move further against you. So by increasing your duration, you automatically increase your risk, but you also increase your reward. When it comes to markets, risk and reward go hand in hand. You cannot have one without the other. So duration is something that we can control. And the last is frequency of trading. That's the number of trades we take. The more selective we are in our trading, meaning we take only the best of the best of the best trade opportunities that are out there, the more likely we are to have good wins. And if you take multiple trades, anything that comes along that looks remotely like an opportunity, then you're likely to take on bad trades. So if you're being more selective, again, you may not have as many wins, but you won't have as many losses, particularly if you're being selective. Okay. So we can increase the number of frequency of trades if we are doing well. I used to equate this to the old radios where you had dials to turn things up and down. And, you would turn up the size, you turn up the duration, turn up the frequency, and, it gets more risk in the markets, more reward, but more risk. If we need to, and nobody has the same settings, they're all three different knobs that we can control. And sometimes we need more frequency, less size. Sometimes we need longer duration, less size, or more frequency. You can adjust them to meet your personal risk management needs. That's the neat thing about this. So we're going to focus a little bit, in a way, on size because I said it's the type of contract as well. And it may even be a bit of frequency today because what I'm kind of looking at right now is trying to reduce risk in our trading of futures. And let's see. Okay. Sorry, just a message I was checking. And one of the ways that you could trade futures, as I said before, is just directional trading, but you run the risk of the trade going against you. That's not the only way that you can trade futures. Okay. You could be what's called delta neutral and trade something called the spread. Okay. And actually, there's a term. I'm not sure if I have the picture of it right now. Let me see. Oh, where did I put it? Bear with me as I find this. Open. Hmm. Okay. Where the heck? Well, I might have to pull up. I did a workshop last week for another company, brokerage, and let me see if I can find what I'm looking for here. Ah, no, that's not it. Where the heck did I put it? Sorry, bear with me. I know I've got this here. Um, I mean, I can do it without the slides if need be. It would help me out and to help you. Where the heck? There we go. I think I found it. I gotta find the actual piece I'm looking for. All right, maybe not. What I'm looking for basically is something called co-integration. Okay, and there are two terms that we typically look at when it comes to our futures trading, and I'm sorry, futures spread trading. So first of all, we could do what's called directional trading, and that's what everybody's used to. You buy or sell depending on the direction of the security. If you think market's going up, you buy. If you think it's going down, you sell. No big deal. Or you can do what's called spread trading. And with spread trading, you're basically trading the difference between two related securities. Okay, that's it. You're trading the difference between two related securities. It could actually even be the same security with different months. So we have two different types of trades when it comes to that. And where are you? Again, looking for this one I did bring up right here. So it's a little bit old on the slides, but again, it doesn't really matter just to show you what it is. So a spread is nothing more than buying one contract while simultaneously selling another. And I mentioned delta neutrality. Delta is a term that a lot of options traders use to explain how much price of their option is going to change based on the underlying security moving. Well, when it comes to futures, it's the same. It's how much is your futures contract going to change in value based on the underlying security going up or down in value. So we have delta with the futures, just like we do with options. I mean, it makes sense. They're both contracts, right? So if we buy something and sell something, well, the buy gives us positive delta, meaning if the security goes up in value, we profit. If it goes down, we lose. And if we sell something, we have negative delta, where if prices go down, we profit. If prices go up, we lose. So doing one of each can neutralize the delta. Well, if you're not trading direction, what the heck are you trading? Well, it's something else, and that's the spread. So this is usually done as one transaction. You have to do it with brokers that recognize spreads, and there are many out there. You can use Thinkorswim, TradeStation. You could use Trade Pro Futures is the one that I'm going to show as example. But basically, you're trading the relationship between two securities. So if we have, for instance, crude oil going to the upside, well, that's not one contract. There's more than one that exist, right? When it comes to these energy markets, you can have as many as 12 to 15 contracts, even more, that are actively being traded right now. As a matter of fact, if I go out to the CME Group website, right there, we go to markets, crude oil, and let's see how many crude oil contracts are being traded. Under quotes, there's a lot of them. Going all the way out to 2026, 28 contracts. Not a lot of volume, but December of next year has 18,000 contracts. That's just today. But what you'll notice is that look at the change for today. The highest volume is actually the December contract. Now it's rolling over, but you can see 1.8%, 1.78%, 1.72%, 1.70, and it's going down from there. Why? The contracts that have the most volume will typically move further and faster in the trend direction. that means the other ones are lagging a little bit. So in my example, where crude oil is moving up, that's a March contract. At the time, that was the front month. But the July contract moved up as well, just not as fast. So that physical distance between the two prices, that's called the spread, the difference between the two securities. Now, what we're looking at, I mentioned there was a couple terms I need to define. And oops, no, I had it right here. Sorry. A couple terms I need to define, excuse me. One, we actually did delta, and that is in the contract price. The underlying movement. When I say contract price, it could be options contract or it could be futures contract, right? We went over that. So we get a change in the contract price based on the underlying movement. Gold goes up, gold futures go up in value. Oil prices go down, crude oil contracts go down in value. That's it, right? It's a typical price movement that we're looking at. But we also have a couple other terms I'm going to define now. And one is correlation. But that's not what I want to do. Try to text. And that is the degree to which two securities move together, or I should say move in relationship to each other. If you have a positive correlation, the two securities move the exact same direction. So if security one goes up, security two goes up. If security one goes down, security two goes down. That's a positive correlation. Well, there's a degree of that. It could be as little as 0 or as high as 100%. Okay, so the scale zero to 100%. And basically 100% positive correlation means they move the exact same way, 1-to-1. Okay, which rarely happens, but it can. I mean, at least over long term, it doesn't happen. Short term, it definitely can. But we also have a negative scale. So there's a negative scale. And again, I clicked the wrong thing. Let's try that again. There we go. With the negative scale, basically, they move opposite of each other. And that scale is 0 to negative 100%. Now, it's usually expressed not necessarily in a percentage. It could be expressed as a decimal. So instead of 90% positive correlation, might be 0.90, depending on the platform you're looking at. So for instance, here on the NASDAQ, I can get rid of this indicator for now, or just hide it. And what I can insert is another indicator, correlation. So correlation coefficient. And let me compare this to, let's say, the Russell. There we go. So this line on the bottom, which I'll need to thicken so we can see it a little bit better. There we go. This line on the bottom shows, as you can see, 100% positive correlation, 100% negative correlation. So it shows us how the NASDAQ is moving in relationship to the Russell 2000, another index. And they're very highly correlated at times, and sometimes they're negatively correlated. So the markets vary, and we can actually trade something that has a normal correlation. As you can see right here, we've broken down in the correlation. It often goes back, but it doesn't always go back right away. Sometimes it takes a little while before it goes back to the positive correlation. But that's what spread trading is all about. We can take advantage of a correlation. Two securities normally moving together, one starts lagging. Now, there's another term that we can look at, and that is called co-integration. And co-integration is two securities will typically move together. They're correlated, but they enjoy a little bit of freedom. And the way that most people talk about this or show, kind of an example in your head, if you will, visualizing co-integration, and this is why spread trading works. We trade the co-integration. Think about two drunks. They don't know each other. One walked out of bar A, one walked out of bar B, and they just happen to pass along the same street for a few seconds. The movements that they have, they're drunks, are wandering around a little bit, stumbling. At least they're walking, not driving, but they have no relationship to each other. The pathways that they take and the movements they make have zero relationship with each other. Well, we can't trade that in futures for spreads. It doesn't make sense. We need a relationship between the two. Now, think about a drunk guy walking his dog or her dog. Okay. A drunk person walking their dog, the dog does have independent movement, as does the drunk, but only to a certain extent because that leash tethers them together. They will eventually be moving down the same direction as long as the leash holds, right? Even though there's a little bit of independent movement. That's what we're trading in futures, is that co-integration between two related securities. So if I change this, actually, I'm going to do a screenshot real quick because I like that with all the notes. And use that for later in something. Anyway, so I changed the security. Let me just go to gold, GC, and I'll use continuous contract. And I can take a look at, well, again, if I do indicators, correlation coefficient, let's look at silver. There we go. And we can see, actually, I could have done it with the example I already have with the NASDAQ too, but we can actually see how they are very positively correlated. But every now and then, so the drunk is walking the dog, but every now and then they stumble away from each other, right? And I can actually incorporate this or compare chart-wise. There we go. See if that works. So once more, I'm seeing the correlation, but I can also see when they kind of separate from each other from time to time. And that's tradable. For instance, let me see, where did we get a breakdown of correlation? Right there. There's a breakdown in correlation right here. This is an hourly chart, by the way. So what day was this? This was Friday the 4th at 8 a.m. You can see they were very highly correlated, about 92, 93%. And then what happened? Gold kind of drifted sideways while silver collapsed. Okay. The dog started wandering away from the drunk, but the leash is going to drag them back together. So what happens is we can trade one of them from that moved too far away. We could buy that's going to come back, and the one that was moved away from, we could sell that one until they come back together. We're trading that spread, that difference between the two. Isn't that cool? And the nice thing is, it doesn't matter if the markets go up or down if they go together, because you're long on one and short on the other. You're covered directionally. We become delta neutral. So in a spread, first, we have to have two related securities. And what we trade, the distance, that's price distance, I should say, between them. And what we're looking for is one of two things. If they're moving together, but you get an idea that one is likely to take off against the other, let's say that we have normal movement, but one may run. Okay, basically, the dog sees the cat and runs to the end of the leash. right? So we see that one security, in this case, silver was the dog. They were moving together, and you see gold is pretty much moving sideways this whole time, right? What happened to silver? It chased the cat, and then eventually they came back together. So if we had bought the dog down here, silver, and sold short gold, what happened? Well, the long on silver profited. What happened with the short on gold? Lost a little money. But what made more? Looks like the long on silver made more than we lost on gold. So the dog was tethered by the leash and eventually came back. We'll say it's in a retractable leash and they pulled it back in, right? That's what we're dealing with. So we have normal movement that leads to abnormal movement. That one's kind of hard to predict sometimes. That would have been here, knowing that silver was going to drop versus gold. We don't always know that. The more common way of trading this would be what's called mean reversion. A mean reversion means you're going back to the average. You're regressing back to the average. The dog will come back to its owner eventually, and they'll go back to their house. We know where they're eventually going to head to. Oh, there's a deer outside my window and a squirrel. All kinds of animals. I keep hearing noises out there. Anyway, so yeah, mean reversion is let's say abnormal relationship will eventually return to normal. That's it. Something that's abnormal will usually go back. And that's what we see right here. So the normal movement with a security taking an abnormal move, that's this one. Let's see, I'll use that fuchsia color and copy it. Oops. There we go. And you can see that they both moved down, but gold moved faster. And that is change the color so it doesn't get confusing. It probably already is, but that's okay. There we go. And then we have the mean reversion down here where the abnormal relationship goes back to normal. And that's where you're seeing them come together. So that's what we can trade when it comes to spreads. Now, we don't chart spreads like this because this is very confusing. If you're not confused already, I'm sure I can do that and confuse you more. Anyway, but that's what we're trading is the difference between two securities. Now, there's actually multiple types of spread trades. One, you can do what we call intra-market, meaning same security, different months. Kind of like a calendar spread in options trading, really, when you think about it. And let me see. I'll do a quick screenshot of this and save this one yet. Let's see, where can I save that? And let's see. Got it. Now, the next one is co-integration versus just the correlation. All right. So where was it going here? Oh, we're talking about the different types of spreads. I said there's two types. We have intra-market, and that's basically a calendar spread. So it's the, let me move this over so we can actually see it. There we go. It is the same security underlying with different months. But we also have intermarket, which are related securities, different but related. There we go. And both of them are good to trade. It's just a matter of what you find as an opportunity. And they're very high probability opportunities as well. One of the things I can show you, if I look, I haven't updated everything yet, but my yearly tracking in wealth with spreads, I've been doing this, like I said, for years, basically, this type of trading. And I'll explain why I do this type of trading too. But taking a look at some of the stats from the wealth with spreads program, 2021, I think, is when I started the program, it looks like. And you can see that the win ratio was 71.11%. And we were profitable. We had a good rate of return on an average rate of return per month and per trade as well. Now, you don't have to be right all the time. That's a neat thing. You can see right here, April, I was only right 47% of the time. And I was still profitable. It wasn't as much, but it's still profitable for the month. In 2022, the win ratio was actually better, 75.96. Rate of return dropped a little bit, I think. Oh, no, I'm sorry, that improved too. Went the right way there. Next year, now we dropped a little bit, 23, but still winning 66% of the time, high probability opportunities, making average rate of return of 31.94%. And the totals are nice too. Okay, no problem, Brenda. Take care. And then 2024, I'm still working on it. September looks pretty bad, but August and September are skewed because August I actually moved. I moved here to Virginia from Florida, so it was only a couple trades during the month. As you can see, we didn't do a lot. September, there are still 9 trades that are open, so the totals are not finished yet. But yeah, I was still doing okay, doing good rate of return, average per month, and higher win percentage. And it's interesting because even on my bad month of August, you can see right there, I had a 37.5% win rate, but still positive for the month, right? And why is it still positive for the month? First of all, the fee to join the program, because I got to charge for my time. It's roughly like $200 a month if you join for a quarterly subscription. You can use the link that was put in there for the Wealth with Spreads if you want to see more info. Plus, you can try it out, by the way, for 2 weeks for free. Okay, there's a 2-week free trial if you do a quarterly subscription. We don't charge your card for the first 2 weeks. You get full access to everything in the program. So I just want to put that out there. But the neat thing is, like I said, I didn't do great. I only won 37.5% of the time in the month of August. But because the wins are larger than the losses, there's a positive for the month. Now, I did have losing months. It's happened. Okay. You can see there's several losing months in 2023. Actually, 2 losing months there. I think that might have been it. Not afraid to show that there's losers out there. It happens. Okay. Anyway, but spread trading is relatively stable and can be profitable if done properly. There's no guarantees, of course, but you're doing delta neutrality, meaning it doesn't matter if the markets crash. It doesn't matter if the markets rally. You're trading the relationship between 2 securities. Now, the way we trade this, I mentioned there's intra and inter. You have bull spreads and bear spreads. I don't want to get too in depth in this. In the program, by the way it works for wealth with spreads, if I go to my page here, I've logged into Wealth Builders HQ's website, Wealth with Spreads. There we go. And basically, I have a lot of self-paced education. Right here, you can see educational videos, spread trading 1, spread trading 2. How to find targets, how to do certain strategies, how to trade on certain brokerages. I have Trade Pro, Interactive Brokers, Omega Charts, a couple others. And we also get together on, I think it's like every other month, and we do what's called Mastering the Spread. Those are all recorded. And we do live Q&A, and I help people out. Of course, I'm always available for my students. You can just send me a message at any time. You just log in and send a message. And every week, excuse me, again, there's self-paced education to learn the strategies, and there's documents that support all those educational videos to help you learn. But every week I post a video idea or ideas, and even the PDF for the ideas. So for this past week, I can show you what it looks like. Comes out as a PDF every roughly Saturday afternoon, sometimes Sunday. And this is the spread ideas for this week. And I digest, or I go through it. Can't remember what I was going to say, not digest. I dissect. That's what it was. Thank you. I dissect the trade ideas, find the ideas, I'm looking for probabilities that are very, very high. Right here, it shows 93% win rate over the last 15 years for natural gas. Looking for a long and natural gas time frame shown there. Charting it, so we use not just seasonal moves, which if you're not familiar, spreads are very seasonal. Securities are seasonal. Things happen on a regular basis at roughly the same time of year every year. You know, when people talk about the stock market, they talk about September and October. And everybody's like, oh gosh, September, October, those are the worst months of the year. Why? Historically, those have been the most negative months. October gets a worse rep than September, even though September is usually worse, because that's when the big crashes came. Black Monday, Black Friday, all those the big bad days happened in October, 1987, 1929, and others. There's the term sell in May and go away. That's a seasonal reference talking about the equity markets when they start to get sluggish and don't really do well during the summer. Or when we talk about the Santa Claus rally. That's in December. Well, November, December, January are usually the three best months of the stock market year. The reason behind that, again, retail sales and economy moving, the Santa Claus rally. That's seasonal stuff. So we can take a look at seasonal ideas combined with technical analysis to time the entries and trades. And that's something that's pretty cool that we can do to increase our odds of being on the right side of the market. So as an example, let's see. These are some of the spreads. Let's see. Now, this is one I'm still waiting for a good entry on July. Actually, let's go September. I mentioned there's quite a few that were still either pending or trading. This was one that we took. This is an inter-market spread. It was trading the Mexican peso versus the loonie, Canadian dollar. And basically, it was looking like this at the time for the entry, where there was a nice buy zone demand area, and the bands are constricting, meaning the volatility was dropping. That usually leads to a big explosive move in price and the opportunity and advantage that we can do. So I was looking to buy when prices came down to 49,150, targeting number one right here, this low level supply. Number two, the zone above it. Heck, we didn't even need the Bollinger Bands, right? That's just an extra indicator that you can use to help identify some opportunities. Right there, prices came into the zone. You can see the buy entry was a little late, but we were waiting for confirmation. And target one was achieved. We bounced off supply. Unfortunately, might have hit the trail stop. And I have the alert set on that to help us as well. Oh, really? That's interesting. In a Roth account, you can't trade spreads for options. Well, this is futures. This is not options, first of all. But depending on the brokerage, I mean, you might be able to open up a futures IRA. I know like with TradeStation, and I contract with them sometimes. But when you go into accounts, I think it's there, retirement accounts, excuse me, they do have futures retirement accounts, TradeStation IRAs. So it depends on the brokerage you're with. Now, I'm not saying that you have to roll your Roth into a different one, but you can see that, there are different IRAs that you can obviously open, but they do allow you to trade futures in retirement accounts, depending on the brokerage itself. So, yeah, I mean, it may be stuck. I don't know. It just depends. So as far as Vanguard, I don't know. I'd have to look more into that individually. You can always email me as well, and I can talk to you a little bit more offline. If you have questions, you can just email at, oh gosh, I forgot what it is now for the email. Support at wealthbuildershq.com. Yeah. So as far as being able to do this, that's a great question. What kind of money would you need to be able to do spreads? Well, here's the thing. If we go out and let me go to, where's here? Trade Pro Trinity. This is just another brokerage that's out there. They offer spread trading as well. I'm not saying you have to use them or you don't, but I can see that they have pretty good margins when it comes to the trading. If I find it, there it is. Here's a margin calculator from that platform. So I was mentioning, holding crude oil overnight, for instance. And we're in the December contract. There we go. And I'll just delete this one. I'm not deleting. There we go. So if you were to hold crude oil overnight, you would need, I'll zoom in, $5,900 just for one contract. Okay. Well, okay, there's some things we could do to make that a little bit less taxing, if you will. Maybe we do the micro MCL. Oh, that happened now. There it is, just MCL, and should be Z24. There we go. So instead of trading the full size contract for almost $6,000, you could trade the micro overnight for 600. Okay, but let's take a look at the spread now. Okay, so we have 6,000 versus 600. But if we did GCLZ 24, which again is that December contract, and traded against GCL, let's do G25. That's the February. Now it shows 11,000, but that's not what it's going to be. Look at this. If I go long on the December 2024 crude oil, go short on the February 2025, the margin is $1,137. That's overnight for two contracts. Okay, not bad. Let's do something else. Let's try the micros. Talk about reducing risk. Now, could you lose more than that margin? Yes. Okay, that's not your maximum loss. But what the heck? MCL, what happened here? Maybe they don't recognize it as tradable. Oh, you know what? I did positive instead of negative. That's why. There we go. -1. $114 for the micro overnight, not $600, $114. Now, again, you won't make as much profits, but you also have a lot less risk, don't you? If the margins are related to risk, it's the same thing with the NASDAQ. If we were to trade the NASDAQ overnight, oh my goodness, right? NQZ24. There we go. And again, take this one off. And right now, the NASDAQ overnight is $24,420. That's a one contract overnight for the NASDAQ. But if we do it as a spread, I'll do March 25. It's $275 to hold the NASDAQ overnight. What? It was at $20,000. Now it's less than $300. Granted, you're not going to make nearly as much, but you're not risking nearly as much, and now allows you to trade overnight where many people could not before. That's even cheaper than one micro overnight, isn't it? What's the micro overnight? If you trade the micro, MNQ, whoops, wrong, sorry. MNQ Z24, take off this one. The micro is $2,200 overnight. However, again, if you did the micro or just the full size futures was $275. What are the micros going to be? MNQ. Oops. Yeah, NQ H25. There we are. It's going to be pennies. It's going to be like $30, I think. Yep, $30. I was right. $28. $28 to trade overnight. Now, are you going to be a billionaire trading that? Heck no. But you could do a lot more than just one contract, perhaps. I mean, for $100, we can do 3 contracts, 3 spreads, and the prices move. The point values and tick values are the same. The spreads don't move nearly as much. Now, let's take a look at that. As a matter of fact, if I go out and take a look and say just the NASDAQ alone, NQZ 2024. Okay, this is a daily chart. And here's a good example. So again, if we bought, let's say here, okay, and we're getting out today. So we're seeing a move from roughly, I'll use the opening price there, 589. Okay, so let me see, where's my calculator? Because I'm not doing this in my head. We've got 20,490 minus 18,589. Let's get a round. That's 1,900 times $20 a point. That's $38,020 profit. Okay. Where were we? What did I say it was? 38,020. But the margin was about 24,000. Forget now what it was. NQZ, didn't have to look it up. Yep, 24,420. So divided by 24, 420, 240, 24, 420. That is 155%. We call it 156%. Wouldn't that be nice, right? So you made 38 grand, 156% of what you put up, which was at $24,000. However, if we did this as a spread, okay, remember now the margin was what, 1,100, something like that. We'll see it in a moment. NQZ to 2024 minus NQH 2025. And it looks kind of ugly. So what we're going to do is, before I do, I forgot what day it was. Hang on. You go back for 1 second because I got to compare apples to apples here. And this may not be the best trade. We'll see. This was done with an entry on the 9th. That's what I needed. Minus NQH 2025. I go to a line chart. September 9th. Now, one thing you got to realize about this security, it's going to move in the opposite direction. Watch. Look at that. Move to opposite direction, okay? So not the same, and now we've just moved a little bit in price. So I'm going to make that about 223. So if we did the same trade, okay, we're looking at about 187.75 to about negative 223 because it's moved since then. Okay, what do we make there? 223 minus 187. Okay, about 36 points. $20 a point, that's $720. So the profit would have been 720 bucks, not 30,000, right? That's a big difference. But remember, the margin was less. What was the margin? The NQH25, 275 bucks. That's the margin right there. You see it. Initial risk 275. So we're looking at $720 divided by 275. That's a 262% rate of return. You tell me which one's better. Okay. I mean, the same thing would have happened if we did the micros. If we did the micros instead, remember, it's only $28 for margin. So if you have the $24,000 available, heck, how many of these spreads could you have done? Yeah, the margin for one spread is 27. You can do almost 100 spreads. Now, obviously, you probably wouldn't because you just do the full size contract. But if you have less capital to deal with and less risk that you can take, you're more risk averse. Spreads are a great example of being able to trade overnight, 275 bucks to hold the NASDAQ overnight. You still get to participate. Yeah, you're not walking away with 30 grand, but you're walking away with 262% on your couple $100, $300 you used. Isn't that amazing? And it's funny that people don't trade these. This is really something that mostly the professionals do. If we go out to a website, cftc.gov, and boy, these professionals do a lot of it too. Okay, right here, market data, there's something called Commitment of Traders Reports, if you're not familiar. This report comes out every Friday, and anybody who trades a large amount of futures has to report their positions to the exchange. Well, we're not that threshold, so we don't have to. I liked bright. Sorry, I didn't realize it was reflecting on me so much. But let's go to actually CME, long format. And what we see, if I go to something more familiar, some of these are not really heavily traded. There we go, lean hogs. If you're trading lean hogs, they have what's called the reportable positions. Those are the big institutions. We are non-reportables. Okay, so we can see right now on lean hogs for this week, well, there's probably about 50,000 contracts that are traded with people, you and I, like you and I. However, the institutions are trading a lot more. Overall, there are 200, almost we'll call 300,000 contracts that are being traded right now in lean hogs. Well, with that open interest, you'll see they have long, short, Now, commercials, by the way, these are people who are actually dealing with the physical commodity. So lean hogs, we're talking about Smithfield, right? They produce bacon. So they're the ones that are cutting up the hogs and making your bacon. Or the farmers who are raising the hogs. Those are commercials. And what they're doing is hedging either against prices rising or against a supply drop and the demand dropping. Okay. The non-commercials are the big institutions trying to make money. And look at what they're doing. They're going long and short, but this column is interesting, spreading. They are trading spreads. This is not something that's very obscure and it's a very, very niche thing. This is something that's pretty common with institutions. 48, 577, 293, 573. That's 16% of all the contracts being traded. They're being traded as spreads. That's almost as much as all the novice traders like us are doing. And it gets to some others, it could be as high as 30%. 56,000 contracts on 300,000. I was going to look for NQ. Let's see, NASDAQ. There we go. NASDAQ 100, NASDAQ mini. There it is. That's the futures we were just looking at. And it's not as big because spreading is a lot more popular on commodities, physical commodities, but 11,000 contracts out of 250,000 are being done as spreads. 11,761 divided by 250, 139. That's about 5%. But still, it's being done. And as you saw, it can give you a good rate of return. So even though I don't make as much money, remember, we did $720 return on an investment of 275 margin, which was comparable to the move that happened in the NASDAQ. We made $38,000, 156% on 24,000. I don't remember exactly what it was, but it was 24,000 margin. And I was saying that if we wanted to, we could even do the micros instead. MNQ Z 2024 minus MNQ H 2025. And again, on the 7th or 9th, sorry, not 7th, the 9th, there it is. Same move for the most part, going from about 187.50 down to, 223 was where I called it. So the movement is the same. Once again, let's see, I'll figure it out exactly. It was 223 minus 187.36 times 2 is $72, right? That's what your profit would have been here. But remember, what's the margin? 28 bucks. That was a 257% rate of return. So using the micros, it was a $72 profit. They say it was 257%. Nope. Rate of return on $20 margin. That's pretty incredible, isn't it? So if you see strong movement in one leg, can you just exit the other? Yeah, you could. There's a lot of different things you could do. You'll notice this is an intra-market spread I just examined. There's also what we call inter-market. I actually showed you that example as well. This Mexican peso versus these was it Canadian dollar. And I used technical analysis on what's called a spread chart to do these. Basically, this spread chart is nothing more than the price of one security minus the price of the other. But when it's not the same security, not NASDAQ versus NASDAQ, what you have to do is use what's called notional value. So when we trade futures intermarket, we have to use notional value. Now, what the heck is notional value, Brandon? Well, it's easy. Market value is what you see on the chart. That's the price of the chart. The notional value is nothing more than market times point value, whatever the point value happens to be. So in the case of the NASDAQ, I have to go back now and see, hang on a second. I'll do this, go back to the NASDAQ. There we are. So for intermarket futures, as I was saying, we want to use notional value. Gonna work. There we go. And right now, 20,500 is what the NASDAQ's trading at market value, right? I'm rounding up a little bit. 20,500. That's the market value times $20 a point. This one NASDAQ contract represents $410,000 worth of stock. So when we trade intermarket, we have to use notional values. It actually helps with the chart too. If you notice, when I was showing you the spread NQ December versus NQH, all this number right here is the difference between the December minus the March. That's the value that's left. They're separated by $252. The front month contract dropped faster than the back month. Now, when we do intermarket, let's say we're going to do the NASDAQ versus the Russell. They have different values. The NASDAQ point value is $20. The Russell point value, and actually we also have to adjust the number of contracts to be what's called delta neutral because of volatility. But the Russell has a value of $50 per point. So now I do notional values here. And basically what I typed up, and you have to know these things, and that's where I come in. When it comes to looking at these markets, I've been doing this quite a while, and I teach this, of course, and I point out trade ideas every week. So if I go, for instance, crude oil, you'll notice it's outright margins. It shows my margin requirements for the individual security, but I can go here to intermarket or even intra-market, and the margin limits change or levels change. Some of them are one-to-one. Not all of them are. Right here, gas, Eurobob, non-oxy, I don't know what even that is, but -3 by 25. I don't know how you do negative contract. Oh no, he's shorting 3 contracts, buying 25 contracts of crude. So you have to do delta neutrality, which gets a little trickier. It's not too bad. The reason why I bring that up is on this chart, I'm basically doing one NASDAQ December contract at $20 per point minus 3 Russell contracts at $50 a point. And that's the correct weighting for this. And it makes a difference. I mean, you definitely need to chart it the right way. So here's the cool thing about charting in notional value. What you get on the right side is dollars on the movement. So for instance, if I'm going to short that level of supply, the difference between the two is my risk. 88,810 minus 86,35. That means that width has a risk of $2,775. And I can also determine how much reward I'm going to get. So notional value charting, it's kind of interesting. And that's what I'm using here for, let's see, where do I have another one? The currencies, obviously. Let's try to find something else. Yeah, this is, again, British pound versus Japanese yen using notional values. 62.5 for the pound, 125,000 for the yen. But intra-market, there's nat gas, May 25 versus July 25. So some of the benefits, again, when you're looking at spreads, is that there are certain ones that come out every single year around the same time. So there's a pattern that you can get involved with and trade with the professionals in that pattern, higher probability. When the margins are reduced dramatically, you have to come up with a lot less cash to be able to trade. You can trade this for, I showed you the margins. I think $28 is probably one of the lowest ones I've seen. I know that you could do, M6E, is it? So the micro euro, yeah, M6E Z24 versus M6E H25. See what the microcurrency spread is. It's gonna be ridiculous. $11. Yeah, they're pretty cheap. Even the full size contracts are relatively inexpensive. I just did the micros just to show you, but if I do 6E, but $11 to trade overnight, it's kind of wild, isn't it? And on this spread, $110 to hold 125,000 euros overnight. So I think it's a great way of trading. It's something I really enjoy doing. I hope you enjoy it as well, and see it work for you. It's much better to do this because you're reducing risk in your directional. Instead of doing directional trading in futures, you're still taking advantage of good leverage using futures, but without all the added directional risk. So it's a better type of trading to do in a retirement account, I believe, because of that, because we want to try to reduce that risk and manage it better. I've got to get going. Once again, if you're interested in joining me, if you do the quarterly subscription by clicking on the link that was put up earlier, we'll do it again. It's under the Wealth with Spreads program here. Let me click on that. There it is. So we'll go ahead and put the link up. If you have more questions, let me know, of course. There it is. But you can email us at support@wealthbuildershq.com. Okay. And if you were to scroll to this page, you see this monthly. You can try it out monthly. It's $295 a month. If you decide you want to do quarterly, it's about $695 per quarter. It's not too bad. It's a little over $200 per month, but you get a 2-week free trial. You just try it out. And if you like it, great, stay in the program. If you don't like it, cancel. You don't have to get a refund because we don't charge you for the first 2 weeks. So hopefully you gained a little bit more knowledge about future spreads and what they are and why you might be interested in learning more about them. And hopefully I'll be the one to help you with that. So I got to run. Everyone have a great rest of the trading day and have a great weekend. I will hopefully talk to you again soon. Trade safe and trade well, everyone. The classes are self-paced. So there's not any per se online classes. What happens with the program is it's self-paced education. I'm always there for support. So if you go to the wrong page, you go to the Wealth with Spreads program, and the education is there. I'm actually re-recording all the videos and updating them now. And then what happens is we do every other month, we do a live 1 hour. I was supposed to do it this week, but I was not feeling well. So I'm actually, if you join, you're going to be able to catch that, the new live Q&A session coming up because we're rescheduling it probably in a couple of weeks. And like I said, then every week there's a video that I produce with trade ideas, and you just follow along with the videos. Additionally, I forgot to mention this. What happens is when the trades hit entry or need to be adjusted that are in the trade ideas, you can opt in for text messages. And real time, I send out when the alert hits, this was on the 15th. It's not every day because these are more swing trades, holding them longer term. But when a trade needs to be adjusted or something hits, like right here, partial profits can be taken, move the stop loss. You get those real-time texts coming out. And if something gets stopped out or if it's an entry, whatever it may be, you get notified in real time, which is kind of cool. So yeah, it's a little bit more of an independent type of study, but again, there's always support. I'm always available via messaging, not even just email. There's a messaging inside the area here. Okay. So unfortunately, I've got to go to an appointment, so I got to go. But again, if you got more questions, support@wealthbuildershq.com, and you got the links. I want to thank everybody for being here.